I was just saying to Timmy that it felt like I've done a lot of things with you folk at Tauranga, but it's actually only the second time I've sat in the chamber since you folk honoured me by an appointment. So it's never a dull day. I've got a new deputy chair, John. Congratulations, welcomed along as deputy chair. And Tina, thank you for a very helpful induction for me to join the crowd. I do appreciate that. But actually, what I think is also perhaps most importantly is a new member. So Wayne, welcome. Now I think you're probably more well known to everybody else than me, but perhaps just a brief introduction from yourself, buddy, to let us know who you are and be welcome along.
Kia ora tātou, Mr. Chair. You're quite right. I had the privilege of sort of reconnecting with some of the councillors I knew in the previous administration and caught up with them last week. And I think I really did get to meet the new councillors. So last week was valuable and enjoyable. But look, to give some brief background in case people don't know. Come from Tauranga, educated and raised here. I whakapapa into the iwi here, Ranganui, and Ngāti Pukenga, Hapu, Ngāti Hangaro, Ngāti Kauhu, Ngāti Pango, Ngāti Rangi. So I'm sort of from here, pretty well connected due to a previous life where I was a lawyer with the local law firm Hollenbeck at Maltby. So I spent 10 years working for Hobeck, but probably poignant to this committee, there's a couple of things here in my travels and lifetime. So during those times, I established in Hollenbeck a specialist Māori legal unit, to which we in those days set up the process by which the raupatu claims were made here in Tauranga, the treaty claims, and in those days specialised in Māori land law. So I bring that to this committee just in terms of a filter. After law, I joined the dark side and joined the corporate world, to which I was chief executive, managing director and directors on a number of companies overseas. And again, probably poignant to this committee, it was in the financial services industry, insurance and banking. So well versed with compliance, risk, and I'm a fellow and mentor of the ANZIF, which is, some would say, is the premier institute for insurance and risk in this country. So I'm a fellow and mentor of that, have been for a while. So I do bring a number of filters, and I just hope that I can add to this committee in some way, Mr. Chair. And but thank you very much for allowing me to sit on this committee, and as I say, hope to be able to contribute some way.
Cracker Wayne, welcome. And look, I know we'll all hopefully make you feel welcome. I have met a couple of times with Wayne, and I have encouraged him to use his voice and bring his skill and use his voice with the committee, as I do with any member of the committee. So it's great to have you on board, Wayne, and I hope you find it profitable. I think we will find it profitable having you here, so that's tremendous. Can I just check, do we have any apologies? I have two, one from Andrew, who's already warned us that he was crook today, and also from Heidi, is not here today. Is there any other? No, I don't think there is. Can I move from the chair that we sustain those apologies? Could I have a second, please? Thank you. Tina, all those in favour, please say aye. Those against? It's carried. Thank you very much. Can I move to public forum? We don't have anybody in the public here, so we can go over that. Acceptance of late items. I haven't been notified of any late matter, or indeed of any confidential business that needs to be brought to the open. I think we keep it the way we are. So, and similarly with our order of business, there's no reason I think that we need to change it. Although I understand, Mohi, we're going to get you out by 2 o'clock. Is that right, mate? Because you've got a meeting for which you're representing us. So that's an encouragement to the chair to actually get on with the job. Okay, can we please move then to item 6 of the agenda, which is confirmation of the minutes. I've got 2 sets in front of me. One of which I didn't belong to the committee at that stage, but I'm sure I'll still sign off for you, Robin, if we can all agree that they're actually right. So we have firstly the minutes of this committee on the 27th of November 2019, and we have the minutes of the 25th of February 2020. I would propose that we deal with them together. Are there any matters of correction or accuracy that people would like to raise at this point? No? Could I then please have a mover to adopt that? Thank you, Tina. Thank you, Kelvin, to second. Is there any discussion? All those in favour, please say aye. Those against? It's carried. Thank you. We've got that out of the way. We have the agenda in front of us. Are there any matters of interest that people need to raise? I don't presume so. That's great. Deputations, presentations and petitions. Which one are you bringing, Clarence? Look, it's tremendous to have you along, Anne-Marie, at this stage to talk with us. Audit's been a hot topic around a good number of audit and risk committees around the country, none the least for the events of COVID, but actually also just doing the audit. So look, if I could leave the floor to you, invite you to address us with the matters you want to raise at this stage, please.
Thank you, Mr. Chair, and committee members. Thanks for the invitation to be here. So normally what we would do at the start of the year, we will go through our audit plan, and every third year it will be our audit engagement letters and our audit proposal letters to be discussed. So I'll just touch on those very lightly, and if there's any questions, I can take those, because that's a bit after the event's already been signed. But if there's any input that you want to do, I can take that into consideration. And then I will just touch on the extraordinary year that we're living in this year and the impact on the audit and the environment that we're auditing in, and the impact on the preparers of financial statements as well, which, by the way, are you guys. So every third year, as I said, we issue an audit engagement letter. That is our standard terms of reference or terms of engagement with you. It sets out my responsibilities as well as council's responsibilities of who's responsible for actually preparing the accounts, and I'm responsible for issuing an independent opinion on those. So that's a standard letter and has been signed by the Mayor. And so I won't go into detail. There's no changes in our engagement with that. The next one that I want to touch on is just the audit fees. So the audit fees, we set that every third year. It's based on the actual time that it takes to actually do the audit. With you, we pretty much came in with a $5,000 overrun or a write-off, which is really good, considering the complexity of the audit, and council was really well prepared. So that was a really good result. For the sector, there's been a flagging of pretty significant increases in audit fees. We went down to the OAG for moderation, lockdown came, and he came out with a letter approving a 1.5% increase on the 2019 fees. In my audit proposal letter, so the increase is only the 1.5%, but in the background, I did say the additional hours that's required to do things like revaluations, that was pre-COVID. There's things like your DIA disclosures, the prudence regulations, all the additional work that came in over the last 5 to 6 years that had to be included in our audit approach. So on average, I would say there's about a 4%, 5% difference between what the increase would have been and what we've been approved to get. And if there's any shortfall, that will be covered or brought into play in the next 2 years, so in 2021 and 2022. So the 1.5% increase is based on the COVID lockdown, and this is pretty much what the OAG thought was prudent in the circumstances. Third one that I just want to touch on is the audit plan. So in our audit plan that we send out every year, that is where we identify the specific risks that we will look at. Now this audit plan was sent out in April, so we were in the lockdown, level 4, I think, at that stage. So in there we have COVID-19 as a significant risk. At that stage, it wasn't as clear as it is now exactly how long the lockdown would have been, what the impact was. I know that with you went out to consult on your annual plan, stopped the deliberations and issued a new one because of the moving calculations and the feedback and everything. So at that stage, we had some idea of what we think we will be looking at with the COVID. Since then, we've issued audit opinions, or trying to issue audit opinions on the December year-ends. So that was pre-COVID lockdown. So pretty much when the end of March, when we had to issue all of those opinions, it was a subsequent event, non-adjusting, because it all happened after the event. But then we looked at the line by line what the impact is going forward, and we wanted it's mostly the tertiaries to do some disclosure around the impact of COVID. For the energy companies at the moment and other companies with March year-ends, they have a deadline of today, 30 June, and we're working very hard to get all of those opinions issued. And the impact of COVID is actually quite significant on the disclosures that's required in the financial statements. There's been some publications made available by the FMA based on the impact of what the expectation is on preparers of financial statements to include in the financial statements for COVID, as well as the impact on the potential impact on the audit opinions. Now, if I use the 31 March year-ends as a basis for my discussion here, the impact will be, or the expectation that we will have is for you to actually have a look at your financial statements and assess the impact on a line-by-line basis. So you're looking at your rates revenue. Is there impact on your potential rates revenue? The flip side of that is your recoverability of your debtors. Whether impact short-term, medium-term, long-term, is there going to be additional bad debts that you have to provide for example. I know you can either do a blanket sort of provisioning, or you can do it with your emissions and actually factor that in to reduce your revenue, but also your bad debts. Then you look at your user fees and charges. You have to impact that, see what the potential impact of that may be on your revenue. And I know that talking to the finance team, just getting to the annual plan, a lot of that work has already been done with different scenarios and the impact of that. So I think most of the work has been done. It's just now how do you disclose that in the financial statements. So that is the revenue, the same with the expenditure. Some of the expenditure may be reduced, some of it is fixed. So all of those things needs to be assessed as well as then disclosed. That is just on the income statement. On your balance sheet, you have all the assets. So you look at your fair value assessments, because the financial statements is based on fair values. And you need to assess what's the impact of COVID on your fair values. Is it land values, for instance? Is that under pressure with the values that you're carrying at the moment? Contractors, is there shortage of skills, or is there oversupply? So it's just a lot of judgments. And because there's a lot of judgments involved in the preparation of the financial statements, there's a lot of audit effort required for that. So with all of that, what I'm trying to say is, at the end of the day, when we do our audit, the fee is based on our normal audit approach. With this, there may be an impact on the additional work that we have to do. The impact on the audit opinion, I would think 99% chance of having an emphasis of matter, drawing the reader's attention to the impact of the COVID disclosures in your own financial statements. So the better that disclosure is, the easier it is for the readers to actually assess that. Audit New Zealand has put out 2 bulletins on our website. The one is on helping preparers of financial statements to assess the impact on the fair value or carrying value of your assets and what to consider when you're actually doing those fair values. The other one is the impact on the non-financial reporting aspect of your financial statements. You know that because you're not for profit, everything is linked to your performance and your KPIs and how that's reported. I know that if you did your congestion survey at the last week in March, maybe it would have been a good result, but without the context of how it's disclosed and the timing of that, it's actually quite meaningless. So it's just taking all of that into consideration and then to think, how will you do that? Now, in our audit plan, we also have our timelines where we agreed with management when we'll come in and do the audit and when we want to report back to council and to make sure that the audit opinion is issued. We're still working towards those dates. I know that some of your subsidiaries, like the Art Gallery, Tourism Bay of Plenty, the non-significant components, the chances of us actually auditing them in our agreed timelines is rather slim. And the reason for that is, with all the additional central government funding that's being spent, there's quite the OAG decided to have a priority system on all its clients. So priority 1s and 2s will be your big central government clients. And if they need staff to do the audits, then my staff will most probably be part of the audit teams. At the moment, we still have our resources, our people resourced to come and do it, and those times to do the delivery, to do the audit. The message that we're getting from Wellington is quality is really important. Timeliness can move a little bit. There's the OAG as well as DIA and Treasury have sent out some letters to notify all the entities that there's legislation going to Parliament to extend the statutory deadlines. Now for 30 June year-ends, we expect that to move by 2 months, so the deadline instead of 31 October will move to 17 December is the date that I've heard. Now, nobody wants to have a deadline then, so we will definitely try and stick to our timelines, but at least there's that buffer that we can actually sign out all our opinions within the statutory deadlines. I think that's all that I wanted to say. Is there anything that I need to add on?
There may be some questions, Clarence, and I've got about 4 or 5 quite, I guess, direct things you said. So, you know, you're making some significant statements around what our accounts should look like, the fact that the opinion will probably have an emphasis of matter, and also that we may be deprioritised and have to come later in terms of it. So I'm not certain those are all messages that I wanted to hear, but having said that, firstly, thank you that you've been up front and said them. I just wondered, before I open it to discussion, I wonder, Paul, is there anything from your side that you'd like to say at this stage, please?
Thanks, Bruce. I think it is probably just worth clarifying a little bit further that point on what it means to our audit program, because the discussions, I know that originally we were, like local government was prioritised 4 out of 4. I understand that's been lifted to 3 out of 4. However, it may have some implications to our CCOs, which won't fit within the timeframes and how that will be treated. Could you just comment on that, Clarence?
So at the moment, you're right, Paul. The priority for local government is priority 3s out of a priority system. So MSD, IRD, MB, all the big central government agencies are priority 1s. The reason for that is so all the entities feeding into the financial statements of government is priority 1, and that is to give the whole of New Zealand comfort and confidence in the system, and that it is audited and reported on time. Also, that deadline or statutory deadline won't be moved, so the 30th of September stays there to give the pretty much all the citizens of New Zealand the confidence that there's still it's still working and there's oversight over the additional spending. So priority 3 seems really low, and it I mean, I fought really hard because 99% of my portfolio is in that priority listing, which means I don't want to work in December or work now in central government and then local government. How we're doing it is we have offices in different locations. So we have our head office in Wellington, that is our biggest office. We have offices in Hamilton, Tauranga, Auckland. Why I'm saying that Christchurch and Dunedin is that we're also trying to resource to do our local jobs locally. So it's not to say because they need additional resources up in Auckland or in Wellington that they'll take all of my staff. But if they do need it, I can then go to my priority 4 clients and take my resourcing or my staff of those clients first, and still try and progress my bigger clients like TSCC and Hamilton City, to make sure that we meet the statutory deadlines and the agreed upon date. Some of our clients, because of the lockdown, have struggled to be in a position to prepare the financial statements and estimated the impact of COVID on their staff as well. And that gives them an opportunity to say, we won't be ready, please, can we go later? So it is working with my clients as well. So it's not just a push factor from us, it's also some of our clients that will say, we're not ready, please don't bother us now while we have to prepare it. And we're working with that in mind and trying to then utilize all our staff in a productive way, making sure that we actually do deliver on all the agreed timelines and statutory deadlines.
Thanks for that. Questions from Council? Yeah, Larry.
Thanks, Chair. You just mentioned priority one was central government. I think I heard from Paul that we were 4 and we're now 3, is that right? So we went up. What's the 2, who sort of normally is in that priority 2 area that would come in ahead of us?
So priority 2 will be all the FMA reporting entities, Auckland Council, so people with public debt, that sort of thing, and crown entities, DHBs, also feeding into the central government financial statements of government.
Thank you, Larry. Any other questions for folk? No? Just a couple of questions from me, if I can, or perhaps even clarifications. I think the first thing I want to note was, perhaps I'm looking towards my fellow members here. You mentioned an emphasis of matter, and I just think I should give a quick explanation of what I see it as. You're wanting to use your ability to report through the opinion that will appear in your published opinion, that actually the reader needs to be aware of the impact of COVID-19 in terms of the judgments we've used inside the accounts. It's not necessarily, assuming we are able to do our work, going to stop you from giving us a clear opinion. So we would get an unmodified opinion, at least in terms of the actual fair reflection of our financial statements, but you would include a paragraph which says, hey, be aware of the note disclosure we make around the impact of COVID-19. So in other words, our opinion will look slightly different because you are going to include additional commentary in it.
Yes, that is correct. So it's an unmodified audit opinion, unqualified, but modified with the emphasis of matter. So it's just drawing the reader's attention to specific note disclosure. And that's why I said it's really important to have those critical judgments well documented, because then people can see what the impact is. With the new accounting standards, IPSAS and IFRS, it is there's a lot of judgments going into in the preparation of the financial statements. Everything is carried at fair value, so your input into, let's say, your waters or roading is based on your assumptions, such as things like your square meterage, your length of pipe, the cost of your professional fees, the cost of your the actual goods, as well as professional fees. So it's all of those things that you bring in, and then your future expectations of when you start going into your for-profits, your cash-generating units, the discount rates, risk-free rates, what is inflation going to do? All of that feeds into your financial statements. So if you start to play around with 3 or 4% differences, and with the interest rates going how it did with your hedging and that, it becomes really interesting, and also it's very important to then disclose those judgments.
Right, and I think I've heard you say, and Paul, I presume you'd confirm that a lot of the assessment work that would be needed to do this should be effectively done associated with the annual plan, which is really good. Paul, can you remind me when do we plan to have our opinion signed off?
October I'm looking at Catherine there.
The court's about the 22nd.
22nd of October.
Yeah.
Yeah. So Clarence, can I leave you with this perhaps slightly ringing in your ears? Please keep to that date.
I will definitely try my best.
And I want to say that for the protection of our staff. We are under stress clearly to get an annual plan out, and we've had to make a call that we go later, which is not inconsistent with the rest of the sector as we've grappled with our plan. I am aware of the move by the Auditor General to look to go out as far as 15 December, but as you well know, we are going to be massively engaged in a long-term plan, and to go much beyond our plan date is a challenge when we need the staff that are involved in a long-term plan still being distracted by an annual report. So, look, if I can just say firstly, thank you that you have been incredibly upfront with us, the effort required, etc. I know that you've raised well, but I'd like to send you away saying thank you, but also to reflect, please, 28 October. I know that you're already saying to us we're your priority one, but you've got to answer to a higher order, I suppose, so I appreciate that. So please do your best. And look, I would welcome you back to the committee to keep us up to date with progress, because obviously we could, I hear the system stressed, we've got to be reasonable about that, but 28 October seems like a good date, mate. Sorry? 22, oh, even better. Okay, 22 October, that's great. Thanks, Clarence, I appreciate that. Marie, thank you for coming along. I appreciate that, and as I say, thank you for coming, and wish you well the rest of the afternoon.
Thank you, appreciate that.
Right, I'm just conscious, Mohan, we need to get you trucking along, so Mohan, could I ask you to come forward? I presume you'll speak, or are you going to Paul, as we consider item 9, which is our Treasury strategy, please.
Hand over to Mohan. The main thing to note in this report that's different to what you've seen in the past is the borrowing, additional borrowing resolution sitting around July borrowing, given we haven't adopted an annual plan, but I'll let Mohan talk through the report.
Brilliant. Thank you, Mohan. Welcome along. Always good to hear your voice.
Good afternoon. This report is a 6-monthly report we do regularly. Last one was on the 27th of November last year, about a month late, but roughly 6 months. It really captures our borrowing component as well as the interest rate risk, which are the two main items, apart from a bit of FX and money market stuff. So looking at the debt management side, there's a graph there on page 32, shows where we are as at end of May. And as at today, it's 539.7 is our debt figure. That's a closing debt for today, for June. And we received 5.1 during June, that's why the increases. That's sufficient cash to get through this year end. And going down, our duration was 6.02, which is our average maturity for all our debt, and it's down to 5.92 by end of today. And that's, on page 32 outlines the debt maturities and new ones planned for the next 12 months. We've got a closing debt of 672 for June 21, which is our forecast annual plan at the moment. And in terms of our borrowing for July 20, we've got 35 million, which is a rough estimate of gross cash flows for the month until the annual plan's approved. And other main ones, bank facilities there, we've got 70 million at the moment, undrawn. And the next bit is our limits in terms of maturity debt limits, which is as per policy, which is in line with the recommended bands at the moment. The June 20 there, and June 19 is an example, previous year. And next, LGFA. LGFA's special general meetings at 2 o'clock today, which is to approve the covenants change for the treasury policy for all the councils. It is expected to pass at this stage. It's expected to get through. Most of our, as you can see, most of our borrowings from LGFA, it's a graph on page 35 shows, and 525 is from LGFA at the moment, and the balance is from HIF, which is just about 15 million. And also outline as attachment, which shows you the average maturity versus the pricing we get from LGFA, which is the attachment to that report. The margins range from 0.39 to 1.09. That's sort of it varies. It's slightly changed since the June figures. End of June is slightly higher. Based on our policy, the profile of our fixed rate debt, as well as our hedging in place, which is sort of a little bit below the midpoints. It's where this also includes forecasted debt drawdown, say 10 years out. For example, the Housing Infrastructure Fund debt's also forecast in there. It's based on that line, the purple line is based on total debt, forecast debt in the future, and how much of it is at fixed rate, like a fixed rate mortgage, effectively. And on paragraph 47, it's got the interest costs, net interest costs position for this year. We're forecasting last month 1.15 million favourable variance. I think it should be pretty close to it end of today. And page 38, the graph shows you for next year, next financial year, what the average rate for all our debt is forecast to be. It's end of today should be 3.8. It's slightly higher than initially earlier mentioned because we haven't borrowed as much as of today, so it's slightly lower, and then forecast to go to around about 3% in the latter half of the next financial year. Those are the key points on the report.
Right, thanks, Mohan. Appreciate that. The importance of us understanding how the operations of the city are being funded. Can I ask, are there any questions of clarification for Mohan at this stage, councillors? Yes, John.
Yeah, thank you, Chair. Afternoon, Mohan. Nice to see you again. The chart, effectively, on paragraph 41, it doesn't have a y-axis. Would that be of help to a novice reader?
Could do is, the idea was to capture the dollar by month, millions in terms of how much of our mortgage is fixed going forward. I had a different graph once before, trying to make it a bit fancier.
Yes, are there any other questions from folk at this stage? No? Right. So, Mohan, I just would like to raise a couple of questions. Paragraph 10, I think it indicates that you will enter the market and effectively pre-fund what our future funding needs are. Is that correct?
Correct. July at this stage. Also July, we are expecting some drawdowns from HIF as well. That could occur in the next week. Some might come out, so that'll push our debt. If technically that's borrowing, so likely to be another 10 million or so coming in the short term.
Yes.
So that's why the resolution needs to be in place, just to make sure not a technical breach.
Yeah.
But we have got for the year in June 19, the annual plan debt figure was 543.8, so there's a little bit of room net debt. So I just didn't want to the
So
technical breach.
the concept behind pre-funding is you are arranging this before we need it, not
Yes,
necessarily imprudent. Does that mean we are going to make a small margin on investment before we use it, are we, arbitraging?
That's correct. We will make a small margin. We did the same this year gone. And also pre-funding is also managing the funding risk in case something happens in April. All the councils are doing it at the moment. Recommended to do it. I do recall back in 2008, we had actually a borrowing on a short-term debt, and it was meant to be rolled on the day, and they said no, thank you. So we had to draw down our facilities. So it's to manage the funding risk more than anything else. And secondary point is the small arbitrage income, which is sort of we're building into our annual plans.
Yeah, no, smart enough. And I take it that at this stage, as you're indicating that the nature of the funding you're taking out at this stage is fixed rate debt.
No, not necessarily. No, all the housing infrastructure funds are fixed rate. The balances we are planning to take floating rate.
Right.
There's sufficient hedging. That's how the graph's built on the interest rate profile graph. So there may be some fixed if there's a really low rates come up, opportunity to, but that will increase our fixed rate position over time. Indications are the interest rate may go down a bit further. So, for example, if we did fix back in April, more of it, then they'll be a lot lower now. So it's trying to get the average. It's hard to pick the bottoms or tops. So trying to get a best average we can.
Yeah, I know.
I think 3% average by the end of next year is pretty good compared to some of the other councils. So we're in a good space there.
Okay, and the other thing is the need for the additional resolution around the 35 million is that in effect because we haven't been able to set our rates, which are obviously consequent from the annual plan. If we had adopted it by the end of today, that's going to delay us in getting our rates and rate income in the new year. That's why we need the facility for July.
Well, I'm hoping that there won't be delayed.
So reason is that once we adopt the annual plan, we then adopt the borrowing resolution. We won't have the borrowing resolution adopted. So that's the reason for that.
It's the timing of the resolution, so it's actually, if we were doing this normally, you would have had that covered because we would have had the normal resolution. I appreciate that. Okay, that's really helpful. Again, sorry. Yeah, okay. Sorry, you're hiding behind Robin's machines here. I'm sorry about that.
Yeah, I was going to ask about that 35 million as well. I saw that's done on the average of our monthly outflows. If there's a slight shortfall, is that covered just by that 70 million banking facilities, or?
Just to make sure that council has approved it in a total amount, can't breach that amount. 70 million is it could be the way of borrowing money, but really that's more the amount of total borrowings we're allowed to have at a point in time.
Okay.
Just add, July tends to be a month going through a lot of tender process and so forth. The cash outflow isn't as high as a normal month, so that will be more than adequate to cover that.
Okay, no, that sounds good. And if I can, that $15 million, is that just working capital management that you've always, is that an amount you usually have?
Yes, yeah, but that's the minimum amount. We do have more generally sometimes. As of end of today, we'll probably have, there's quite a big batch being prepared at the moment, so around just under 15 million today, close of business.
Timmy.
Thank you, Chair. Just to clarify, with the 54 maturing, what's the weighted average cost of capital? And I'm asking this specifically because if 3% is good compared to other councils, if I heard you correctly, Mohan, then what should we be aiming at in an environment where interest rates are absolutely trending down and local government NZ's at, I think, 1.5 or thereabouts at the moment?
On the attachment to the report, it shows you the average rates for the maturities. I think 2033 is about just under 2%. That's the rate we can borrow from LGFA. I think that had 1.94. the latest one has got 2% on it. I mean, below 3, historically, we've never been this low ever before. Getting it below 3 would be, the 2 in front of it, average rate for all our debt would be exceptional. So, because you have got margins to pay as well. We do pay all our borrowings. We've got a 0.25% margin built into the wholesale rates, market rates, to LGFA margin as well. So that's, that's built in as well. So any facility fees are all included in that all-up cost. So below 2%. New debts, as you know, is a lot cheaper based on that sheet, but we do have got hedging in place, which we put in place 2008, 9, 10, 11, that period. So they are at 4s. The average cost of maturing debt, the 54 million, 50 million of it, they were all floating rate debt. So their margins range, average margin on all our debt is about 0.73. So plus that will be probably closer to 2%, that debt maturing.
Sorry, firstly Larry, then John, then Wayne.
Thanks, Mahan. Having watched for a few years your skill in this area, I'm a little bit like the fools rush in where angels fear to tread. But your comment earlier about going for floating rates on this funding in July, you know, I sort of think, well, but it's fixed so low right now. But you're expecting it to go down, and if it does, then you will fix it at the lower rate. And the risk of it not going down and going up, which is probably minimal, but your experience of that possibility, can you comment?
I think the rates will go down a bit more, way the Reserve Bank's intervening in the market, expected. It really goes back to that page on page 37, the graph on there. It's really trying to keep that in those bands together with the average rate, what we can achieve. So if you say, for example, if we fix $100 million for 10 years or 12 years out, that will be 2032. That line will come up significantly. So based on the current policy, we're not allowed to have only 30% of our debt that far out fixed. It's trying to get an average, not assume that it is the lowest it's ever going to be. It might be lower, it might go negative, don't know. So that's the idea, is the policy framework is to trying to get an average, best average, and risk averse, not to speculate.
And supplementary, if I may, just because the world has changed, kind of in terms of interest, the changing of our policy is an LTP discussion. Am I correct with the financial policy, whereby we might change those bands?
Yep, that's right. It's before Christmas. We're doing a plan to do it part of the LTP.
Thank you, Larry. Appreciate that. John? Thank you, John. Thank you, Yako. Wayne, you've got a question, sir.
Thank you, Mr. Chair. Really, it's just for clarification for my own purposes, to be honest. I see in the papers it refers to something called the Treasury policy. So, I mean, a lot of this talk is about investment. Do we have a finance and or separate investment policy that we should be aware of and become familiar with and know I'm sure you've got bands and where you park your money when you've got it, where to invest, but is there a document I can put my hand on so I can contribute more to this conversation?
The Treasury policy itself got a section on investments section. It's under the Local Government Act. There's 2 bits, the investment side part of it. We don't normally have much investments. There's only mainly for working capital investment. We don't have a assets portfolio like a share portfolio or a long-term bond portfolio. We don't have anything like that. So it's really the rates money received or borrowings. It's all to cover in the next sort of 3 to 6 months, covering the funds. So that's what we invest is the 4 banks basically at the moment: ASB, BNZ, Westpac, and an ANZ. We've sort of been investing with them the short-term deposits. Before 2008, we invested in corporate bonds or the other commercial paper market and the wholesale market. But since then, we've just stuck to the 4 banks, low risk. Policy also restricts in terms of the credit rating who we invest with. Minimum A. So, yeah.
Thank you. Is there any other questions for Mohan at this stage? In that case, I'll put the motion, moved by John, seconded by Yako, as is in front of you, noting the specifics of E, which is because of the extraordinary timing this year for the annual plan. All those in... Oh, sorry, yes, I've given you the chance to sum up. Sorry, John, bad performance. Go from there.
Thank you. I imagine you could do it better yourself, Chair, but thank you for the offer or the opportunity. Yeah, look, this is a regular report, and the questions asked by Wayne, I think, are apposite. It's important for us in our role here to understand the underlying strategy. It's quite significant. My observation would be that, as ever, there's nothing out of the blue in this report. The observations around pre-funding and arbitrage, I don't think it's an arbitrage opportunity. There's a very small amount in there. It's more about de-risking, really. But yeah, as ever, there are no surprises, which is one of my favourite experiences of this report and Mohan's work in this space. So I thank you, Mohan, for your work, and commend this report to my colleagues.
Yeah, very quickly, I think it's all sensible, and we should definitely be dollar cost averaging or taking the average of the market rather than timing the market with our debt, because you never know what's going to happen, as we've seen recently. Yeah, in terms of all the cash flow management, sensible, which is probably what you want to see in a report like this, so happy to endorse.
Thank you very much, Yako. Thank you, John. So I'll put the motion. All those in favour, please say aye. Aye. Those against? It's carried. Thank you very much. Mohan, thank you for your input again. Obviously appreciated. And I noted you mentioned the word LTP in the middle of that, and it just shows you how much we're going to have to do to get this LTP through. It'll be a big one. Right, can I keep us moving on at some speed? Item 10 is late items. We don't have late items, so I can move over. So we need to have a resolution, please, to move into public excluded. And you have, actually in your papers there, the reasons for it. The reason that we need to move into public excluded. Could I have somebody prepared to move that, please? Thank you, Tembi. Thank you, Dawn. All those in favour, please say aye. Those against? It's carried. Thank you very much. Do I need to wait for you to turn something off?